Welcome to Take 5 Tax Tips with Kelly. This video is for Canadian corporate owners. So you've incorporated. Now what? We're here to help walk you through those steps in the beginning to make sure that you're starting off on the right foot. This video is going to focus on how to pay yourself out of your corporation. One of the things we don't want you to forget to do is to pay yourself. Because if you're not paying yourself, then what are you in here for? You need to be in business so you can make money. That is the reason that you're here. While you may have the love for what it is that you do, it's also important that you're able to sustain your lifestyle in order for you to be able to continue to practice in doing what you're doing. Now, with paying yourself, you do have options. So you can either pay yourself through a salary or pay yourself via dividends. And sometimes you might even want to choose to do a little bit of both. We do go through all of these different steps that we're going to talk about today in a blog that we did put on. So if you want a reference material that you can refer to, please refer to the link that we're posting here right now on this screen. Now, when it comes to payroll, it is going to be one of the ways that you're going to be paying yourself probably the most to the government than if you were to go through a dividend route. And the reason for this is because there are withholdings that need to take place. And you're also going to have to pay tax on these amounts a lot sooner throughout the year. Payroll remittances must be made 15 days after each month in which you are paying yourself or any other employees that are working for you. As a corporate owner, you do not need to do any withholdings with respect to EI, which is your employment insurance, and the reason for this is because you're also not eligible as a corporate owner yourself, and the reason for this is because you are in control over how much you pay yourself, and the government recognizes this and will not also give you the ability to lay yourself off as the owner in order to collect any EI. So for that reason, that's one of the reasons you also don't have to contribute to it as well. CPP is another situation though. This is where you're going to be contributing into the Canada Pension Plan, and you'll be able to draw down on this when you retire at a later date. Now, one of the other reasons that you might want to do salary is because you want to have RSPs that you're contributing into. In order to contribute into RSPs, you have to have payroll, and you must have salary T4 income that you're going to be issuing out of the corporation in order to generate the amount of room you can contribute into an RSP. We'll get into RSPs a little later as well. But it's just important to understand that piece, that you do need to issue yourself some payroll if you need to generate any of that RSP room. Now, dividends. This is one of my favorites because there's a lot more I can do with this one. There's a lot more around tax planning we can do, and a lot more flexibility around when you pay yourself throughout the year. And you can really look at the full picture of the corporation before you decide how much to pay yourself, because you'll know at a later date, for example, how much money is sitting in the corporation, how much it can afford to pay you at any point in time. And your tax bill on the personal tax side is a lot less. You're not having to remit throughout the year for any of these dividends that you're paying yourself throughout the year. So this can be a really great tool to use and a really easy way to pay yourself throughout the year. Year one in particular, when things are spinning all over the place and you don't know what's happening and there's a lot of uncertainty, dividends are usually the route I choose for most people, just for this reason. So you're not going to be penalized at any point from CRA for being late on anything when it comes to how you've paid yourself. But one of the most important things to remember is that any money you do take out of the corporate bank account, or any money that you're spending from the corporate bank account or corporate credit card, is considered to be income to you. So you have to recognize that piece. And every time you're taking any money out of there, always know there's going to be a tax bill attached to that. So there's no surprises at the end of the year. One of the considerations to think about when you're deciding between choosing salary over dividends is, what are your future plans? Because you'll want salary if you're planning to go for any loans or mortgages, because it does put you in a better financial position when it comes to any of those applications that are in play. So really important to make sure your accountant is aware that you are planning to go for a mortgage within the next 2 to 3 years. So those things can be factored into your plan as far as whether to have any payroll or whether to have any dividends, and making sure we're optimizing the right amount. We also do have the ability to help you with that financial position by giving you more payroll in some earlier years and less after the mortgage has been applied for. Lastly, when you've decided on your payroll and dividends for the year, You want to make sure that you're issuing T-slips for them. If you've issued yourself payroll, you're going to make sure that you're going to issue yourself a T4 slip. If you are issuing yourself dividends, it's going to be a T5 slip. Now, regardless of what your year end is, these are all due at the same time of year and must be remitted to CRA by the end of February. If you have any payroll deductions that you have not fully paid, you want to make sure those are also paid by January 15th. That's your deadline for that. And these are all based on calendar year, regardless again of your year end, from January to December of whatever amounts that you took out, because that's going to follow the year that you're going to be filing for your personal tax returns, and it must match. For more Take 5 tax tips with Kelly, make sure to subscribe to our channel.